Hello and good morning, everyone. Welcome back to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. If I could sum up the theme which seems to be prevailing in the markets currently, it would be that of a US dollar comeback. Currently, the data coming out of the US has been supportive of the Fed's stance higher for longer. With the latest set of data, the divergence between the Fed's view and the market's view has slowly been narrowing, and that has resulted in a broad based dollar strength. Yesterday's PPI number came in higher than expectation, leading to a climb in the yields and the dollar index. We also had three Fed presidents speaking yesterday night. JK, take us through the updates. How are you reading the PPI numbers and the Fed president speeches?
Good morning. I think, as you said, the market's view and the Fed view on the interest rates are now almost matching. And in fact, some market participants have started to expect even a rate up to 5.50 on the peak US interest rates. Definitely, it was all driven by the inflation data this week, and the data on inflation as well as other numbers have actually steamrolled the bonds and the stock markets, while dollar has continued to post gains. With most market participants keen on how the Fed policy evolves from here on, this week's economic data can be considered somewhat decisive. After a hotter than expected CPI number seen Tuesday, PPI or final demand in the US declined to 6% on a yearly basis in January from 6.5. Though it was a decline from previous month, it came much higher than what the market was expecting at 5.4%. The annual core PPI edge again lowered to 5.4% from 5.5% previously, but again well above the market's consensus of 4.9%. So what the market had discounted and the actual numbers have been quite variant to the upside. Initial weekly jobless claims decreased by 1,000 to 1,94,000 for the weekend at 11th February, again surprising the market with a slight drop, confirming that the job market is still quite strong. Of course, the manufacturing and housing data are weak, as it has been for several months now, and mainly impacted by higher input costs and also the higher interest rates. Post data mentioned, we heard Cleveland Fed President Mr. Online saying he saw a compelling economic case for keeping the pace at 50 basis point hikes. And the well-known bull, or you can say hawkish bull, had confirmed that they preferred 50 basis point hike in the last Fed meeting. And importantly, this was all before the last month's blockbuster jobs data. I mean, their preference for 50 basis point hike was even before we got the job number and the inflation number as well as the retail sales number. Therefore, one should presume that currently their view would be even more well entrenched. Regarding the 50 BP hike in March meeting, Bullard says he would not rule out again supporting it. And his overall judgment is that it will be a long battle against inflation, and we'll probably have to continue to fight inflation resolve as we go through 2023. So basically, he's ruling out any pass or even, and of course, a rate cut also. Data and hawkish comments have been enough to push up the yields further, particularly in the long end, even as more issuances have hit the market from the Treasury. Not surprisingly, Wall Street ended sharply lower with all three major indices closing in the red. Global Composite Index was also in the red, but its technical picture shows a possible further decline. Dollar has continued to gain, backed by good economic data and higher inflation numbers, keeping alive chances of rates going up to 5.5% according to some analysts. Having surmounted the big resistance at 104.05, the DXY seems headed towards 106.20, Euro perhaps towards 1.0450, and GBP to 1.1650. All, of course, still the minimum requirement of retracement of their big moves lower since last September. Big moves lower in the dollar index since last September. We look forward to the retail sales data from UK as well as the leading economic indicator from the US tonight. After being the best performing major currency, AUD has turned on its head, losing almost 5% from its peak, mainly driven by the lower unemployment data, though it was pushed up by the higher inflation numbers. Against the yen, dollar also hit a 6-week high after it's moved up in the US, and but now the market seems to be waiting for the speech from the new BOJ nominee to become the next governor at a confirmation hearing at the lower house of parliament on February 24. So we are in a dollar bullish environment, mainly driven by US economic strength. However, if the inflation continues to rise again and the rate hike expectations keep getting pushed up, one cannot be sure whether the current economic strength can be maintained. So that's a big question for the equity traders and the bond traders as well. On the rupee front, we did have a positive reaction from the rupee to the lower trade deficit, which was at 1-year low of 17 odd billion compared to average of around 24 billion in the last several months. Of course, the import falling in a big way contributed to the deficit coming down. Once again, the dip was used by importers to buy back the dollars, rather hedge themselves, and the dollar index moving higher also ensured that the rupee did not run away to the upside. The lower premium is a deterrent for exporters to hedge in a big way, while the expectation that India's interest rates will move further higher and keep the nominal rates attractive, kept the foreign investors interested. Interestingly, some of the big institutions have called for rupee to gain against a host of currencies. That's a market call, and also one of the leading US investment house has expected that India will post the highest growth in the global economy in the coming year. So ending with that positive news, TGIF. Thank you.
Thank you, JK. And just to summarize, markets continue to expect higher terminal rates for the US. We saw PPI come in higher than expectations yesterday. Weekly jobless claims decreased, and it seems that job market seems to be somewhat resilient, while the housing and the manufacturing in US continues to be weak. Coming back to some Fed speeches, Fed presidents continue to be hawkish with a preference for even a 50 basis hike, while yen traders would be looking at the speech from the new central bank chief. For rupee, a positive reaction yesterday was due to the lower trade deficit data, primarily due to the sharp fall in imports. And importers, however, use this particular dip to buy and cover their exposure. So, in an expectation driven market, any divergence from expectations can keep markets volatile. That's it for today. Keep managing your risk. Thank you so much for listening.